Welcome to our final taking stock video for the year and also the week ending the 16th of December 2022. I'm Kian Trin, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome to you, Matt.
Thank you for having me for one last time for 2022, Cam.
It's a pleasure, Matt. And also, just before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented shouldn't be relied upon as a guide for future performance. Well, Matt, it's been a volatile week and also a volatile year, especially for the equity markets, with markets declining significantly in the first half on the back of those inflationary pressures, even recession fears, and of course, aggressive interest rate hikes.
Yeah, I think these factors can help mark the end of what we're sort of calling that rampant speculation era, where markets were largely fueled by excessive government stimulus and what we believe to be ultra-accommodative monetary policy. And as we all know, the inflation journey has unfortunately escaped the bottle, and interest rates have had to rise in an attempt to try and bring supply and demand dynamics back into balance and stabilise consumer prices. But now we aren't there yet. And as a consequence of these years of reckless spending and financial ill discipline, there are pockets of the market that are extremely vulnerable as these current tightening dynamics play out. Most concerning to us has been the rise in these so-called zombie companies. And we estimate some 35% of all ordinary stocks fall into this basket in the event of a recession. So this is why we expect to see a continued rise in the number of corporate insolvencies across Australia in 2023.
Yeah, that's going to be quite interesting in 2023, and you certainly won't need a genie if you've got the financial health model. But 2022 certainly marked a year of pain for investors, especially those who listen to the stories instead of focusing on the facts. But it was also a challenging year for quality growth and income investors as well, Matt. And you can see this with the chart on screen, which compares the growth to value ratio in blue with interest rates and bond yields in orange and grey. And over the last 2 years, rising interest rates have dampened the demand for growth stocks. And you can see this by the decline in the blue line.
And not only that, it's also been a year where global recession fears have made investors shy away from small caps towards the perceived safety of large cap stocks. And you can see this clearly on screen here. There's been a large divergence between the ASX 20 stocks and the Small Ordinaries Index. And whilst we like a few stocks in the top 20, don't we, Ken? Our members will appreciate we do prefer to position our portfolios according to the underlying quality fundamentals of a company, which means we provide investors with a little bit more balance across small and large cap stocks. And this is very different to these passive index funds, which blindly position their portfolios according to which stock is the biggest. So this has led to some underperformance this year of our star stocks and our funds also.
And history does suggest that indiscriminate selling across quality small caps, growth and income stocks can represent wonderful opportunities for investors. And this has been evident with the performance turnaround in the later half of this year across many of our star stocks, especially among those that provided positive trading updates over the AGM season. For instance, we saw strong share price recoveries from government software provider Technology One, even retailer Premier Investments, and a lot of the other retailers as well. And of course, also automotive cooling system specialist PWH Holdings.
Yeah, it was. There was a handful of really good AGM results, wasn't there, Ken? And I think largely, though, the reason for the recent rally across equity markets broadly, and particularly quality stocks, has been spurred by expectations that inflation has likely peaked, and therefore there is some light at the end of the tunnel with regards to this tightening cycle that's playing out in Australia and across the globe. And this week, the US reported a decline in its annual inflation rate to 7.1% in the November period, which was down from 7.7% on a year-on-year basis in the prior month. And similar to Australia, the US Fed has begun to ease the pace of its rate rises, lifting the Fed funds rate only 0.5%. In previous cycles, it had been 0.75%, and projecting that the Fed funds rate may peak at about 5.1% next year. So they're not too far away with regards to the end of this tightening cycle. And despite market fears of a recession, the Fed Chairman Jerome Powell mentioned a soft landing was still achievable, especially if the inflation rate continues to come down at the rate it has been most recently.
Yes, Matt, the softening inflation figures, we've started to see signs of a recovery, as you said, in those quality growth stories. And, they could represent opportunity. And over the next few weeks, our research team will be scouring the market to identify companies that are worthwhile of Star Stock status, especially now that more transparency has come under Golden Rule 3, the outlook and active risks following the AGM season. And we will also be transitioning some of our borderline star growth stocks to star growth stocks on the back of the improving outlook landscape, and also the fact that it is likely to be ranked quite highly when they report next period. And one of those opportunities, Matt, was newly elected borderline star growth stock and also star income stock, NIB Holdings, a health insurance company. Now, the company experienced positive earnings revisions just recently, with earnings growth expected to rise by over 40% this year.
A pretty big number, isn't it? And the reason for the strong growth outlook can be attributed to a number of different following tailwind factors. And firstly, it's the reopening narrative, which is, should benefit its travel and international health divisions. Rising interest rates should help yields generated from their investment portfolio, which is largely consisting of defensive assets like cash and short-term bonds. The rising premium dynamic is playing out in line with inflation, and that is combined with this pretty subdued claims environment. The ability for NIB to win market share is also a tailwind for them on the back of the cybersecurity issues that we experienced this year with Medibank Private. And last but not least, the recent acquisition of Maple Plan, which is a manager of the National Disability Insurance Scheme, NDIS. This should also help drive long-term growth within the business.
And that strong earnings revisions, Matt, is also expected to support its above-market gross dividend yield of 5.2%. So the stock is also worthy of star income stock status, but please review the active risks to make sure you are comfortable with them before making an investment. And also within the financial space, over the week, regional bank and star income stock, Bendigo and Adelaide Bank, they rallied on the back of their positive trading update, where, similar to other banks, Bendigo did reveal stronger than expected rise to its net interest margin. So that is the difference between its lending rate and the rate it pays out in deposits.
That it is, and this has led to strong positive earnings revisions and should support its attractive gross dividend yield of about 9% for the year ahead. And also note that Bendigo Bank tends to have a higher yield than the other major banks, and that's largely to compensate for the higher risks of being a smaller bank, which means it usually has more expensive funding costs and lower return on equity due to its revenue sharing arrangement within the community.
Yeah, good point there, Matt. And moving on to our corporate calendar for the week ahead and also the year, borderline star growth stock Incitec Pivot is expected to host its AGM on the 20th of December. Meanwhile, many star income stocks, especially in the REIT sector, will also go ex-dividend at the year end. So some interesting names here include BWP Trust, Arena REIT, and also Waypoint REIT as well. And now for Under the Microscope this week, we take a closer look at the Australian government's proposed introduction of a 12-month price cap on domestic gas prices supplied into the East Australian market. The aim here is to insulate Australian manufacturers who rely on gas for their production and keep them competitive against the imports. It would also help Australian families cope with their higher energy bills as well. But this is an emerging active risk across the oil and gas producers within Stock Doctor's Star Stock universe.
And the implications of the bill, Keen, have been terribly difficult to unpack because there are several moving parts to it. But from what we understand, the price cap will only be applied to gas supplied into the East Coast market at a ceiling price of about $12 a gigajoule. And the spot price ceiling would only apply to uncontracted revenues and will be in place for a proposed period of 12 months.
Yes, you need to jump into the finer details there, Matt, but the immediate impact of the price cap on star stocks like Beach Energy, Woodside Energy, and also Santos is considered minimal, given that most of their revenues are already contracted and are on average receiving prices that are already below the proposed $12 per gigajoule cap. However, 19% of Beach Energy's East Coast gas volumes are uncontracted in financial year 24, and this represents about 30% of their total revenue. As such, if the price cap was to extend beyond the initial 12 months, it could represent a headwind on Beach Energy's revenues and profit margins. But in saying that, the overall impact is still quite limited, given that Beach's current contract pricing should already be below the proposed price cap of $12.
And for our members out there that are long Woodside and Santos, the impact is even more benign, as these companies don't have much gas volumes going into the East Coast market at all. So it's unlikely that the price cap will have much of an impact on their revenues or profit.
Yeah, so this active risk is quite limited for those stocks, but investors should remember that while changes to government legislation is an ongoing risk, the biggest factor impacting oil and gas producers is the oil price, which has declined from recent peaks and has contributed to the negative earnings revisions for Woodside and Santos just recently. And although these companies are well covered by consensus, the outlook remains highly uncertain because it does depend on changing oil price assumptions.
Yeah, that it does, Ken. And currently Woodside has one of the highest gross dividend yields within our Star Income universe of stocks at around 15%. And the yield reflects strong free cash flow projections and contributions from the recently acquired petroleum business from BHP. And although this figure appears sustainable for now, we will continue to keep a close eye on the oil price and changes to its cash flow projections for the year ahead.
Yes, Matt, the yield does look irresistible, but for income investors, this is not your traditional defensive income stock. So we'll be definitely keeping a close eye on this one. And as we approach the end of the calendar year, an appropriate question for investors now is, what is the market outlook for 2023 and how should you position your portfolio for the year ahead? No doubt next year will mark another year of uncertainty, but rather than provide forecasts, we think it's more valuable to concentrate on the facts. And looking ahead, there are some key positive catalysts for the market, and they include a further softening in inflation and interest rate expectations that could possibly continue to help our quality growth and income stocks. You also could have more accommodative policies in China, and we've begun to see leading indicators suggest a recovery in economic activity here. And potentially also you could see the end to the Russian-Ukraine conflict as well. And earnings have remained quite resilient as easing supply chain pressures offset the impact of rising interest rates and slower economic growth. In fact, outside of the resources, earnings growth across the banks and industrial stocks are expected to be quite strong at over 10% for this year.
But Ken, yes, we are acutely aware of the fact that recession risks in Australia and in the US are growing, and therefore these current projections could be revised down if this does and recession does play out. But as we've highlighted in recent weeks, there isn't a really strong correlation between share market returns and recessions. So trying to time your way in and out of the market can be fraught with additional risks. What we do know from history, though, Ken, is that share markets have a high probability of bouncing back strongly following the end of a recession. And on average, the return has been about 16%. Hence, investors should view the year ahead with some level of cautious optimism.
And at the portfolio level, Matt, the best strategy, of course, to mitigate against recessional risks is to remain diversified and invest in at least 15 stocks, and also ensure your asset allocation to equities is appropriate for your stage of life. Then focus on those fundamentals of the business. Invest in financially healthy businesses with strong balance sheets, those with large market positions represented by their net profit margins and high return on equity. Invest in those companies that are generating recurring cash flows to provide sustainable dividends.
And even though some of these quality stocks could be sold down, volatility is going to remain. Due to the heightened economic uncertainty, you should rest well at night knowing that unlike these zombie companies that we've pointed out throughout the year, quality companies should survive and prosper in the following years to come.
Yes, wise words, Matt. And I'd like to say, Matt, thanks for your contributions over the course of these taking stocks. And also, it's been a pleasure working with you over the past year.
To you too as well, Clean. It's been a pleasure. And I'm looking forward to joining you again in 2023, which I'm very confident will be a year where quality returns to the fore.
Let's fingers crossed there, Matt. But with recession risks rising, you really need to focus on those financially healthy businesses. Just a reminder also, our Lincoln Live will be held on Monday. That's the last one. So please come along if you have any questions. We will resume Lincoln Live and taking stock around the first week of February next year. But we hope you found the live interaction insightful. Also, our Christmas sale is close to ending. So if you have any friends or families who could benefit from our research, support and education, then please feel free to share the news with them. It's a gift that continues to give, especially with the uncertainty for the year ahead. And despite a challenging year, 2022 was one that really shone the spotlight, especially on the importance of focusing on financial health as insolvencies rise and the era of speculation comes to an end. And we look forward to 2023 as a year of opportunity, Matt, despite recessionary risks. From our Lincoln family to yours, we hope you and your family have a safe and wonderful holiday season and a prosperous new year ahead.